Because of the moves that we've seen in markets and we're going to see in the real economy, central banks and governments are finally coming in with huge levels of combined support. This is effectively MMT, this is helicopter money. But what does that mean for things like inflation? What does that mean for us? That's what we're going to look at in the big conversation. This has been the fastest descent into bear market territory that we've ever seen. I think it's been about 16 days for the US markets. And obviously it's gone way beyond there. And so clearly now the question is this going to be a recession? Normally that's down 40%. We're not far off that at the moment. Or is this going to be a deep recession? Equity markets usually fall about 60% in that scenario. Or a depression, which is often more like 80%. And obviously this matters because clearly it also depends or defines how long it'll take to recover. And I think, as we've said before, one of the key elements to all of this is understanding the market that we had before this all blew up and what that framework was all about and whether that framework has now been damaged beyond repair. What we've seen so far, I think, has been two phases. The first bit was the economic shock. It was that sudden realization that there was a problem, and that was that first sort of week and a half, 2 weeks. About 2 weeks ago, we said, look, this has now gone beyond that. This is now a deleveraging story. It's a funding story. It's a shadow banking story. And that really was the bit that drove us that second leg down. It's where we started to see bonds selling off, or at least partly selling off, and then not rallying much, even as equities continued to slide. We saw funding spreads blowing out, and then we eventually started to see the dollar rise against pretty much every currency. The next question really is, where do we go from here? And we go from that economic shock to a funding VAR deleveraging shock. But then we have to go to the economic reality, and the economic reality being that if we're putting economies into a coma for an extended period, it could be 1 month, 2 months, maybe it's longer. People are talking 12 weeks minimum in the UK for older people to stay indoors. So how long are the supply and demand lines going to be out? And obviously this is a massive shock on both supply and demand. Well, what really matters here is what was the framework and has the framework been broken? The framework that's been in place since 2008 has largely been one of central banks being in the driving seat. Central bank liquidity, low interest rates, and they were providing lots of that liquidity, which effectively got into financial assets more than it got into the real economy. The key driver of all those years was that central banks suppressed volatility. They wanted to keep a lid on realized volatility, whether it happened in the FX market, the bond market or the equity market, or even commodity markets, which is what happened in 2014, 2015. As of now, it looks like they've failed to suppress that, clearly. The problem is that the whole of the financial framework was effectively predicated on the back of central banks controlling volatility. And what do we mean by that? Well, this was effectively yields would be lower for longer. It also meant that GDP growth was very low. It was fairly constant. We haven't seen many real recessions over the last 10 to 12 years. We've seen some regional recessions. We saw some industry recessions. But we were never seeing a global-wide impact and therefore a global-wide deleveraging. By keeping basically both growth and also volatility under check, it allowed people to build up into these effectively low volatility systems. And this is what we've basically seen for the last 10 years. We've seen active managers bleeding their funds. Those funds have been disappearing from the active towards the passive, the rules-based, the smart beta, the risk parity funds. We think that the number of funds in that bucket, this is the rules-based bucket, overtook the active bucket sometime last year. And those flow of funds have been chasing very similar principles. And we talked about this before, how effectively the whole market has been following the same investment principles. It's been looking for minimum volatility in stocks. It's looking for balanced portfolios, often leveraged into bonds, on the assumption that bond prices would go up when equities sold off. And then when equities rallied, bond prices wouldn't go down as much. So overall, bonds went up and equities went up. So you won on both sides of the equation. Well, today, clearly, it's a very, very different regime. And is this a regime that's now going to persist? Have we completely broken the old regime? And why does that matter? Well, the other element towards all of this is things like the share buybacks. Share buybacks were effectively corporates. They were either reinvesting their profits into shares or they were leveraging themselves. And this was the important bit, leverage themselves in the corporate bond market to buy back shares. They didn't carry large cash buffers for a rainy day, which is the problem today. They didn't do much capex for future growth. So this is always about effectively pushing the price of their shares higher. In the world today, the real world, those corporates no longer have any cash flow. It has disintegrated. It's not quite zero, but in real world sense, it's close to zero compared to where we were historically, even through the financial crash of 2008. Now, these companies may get bailouts, but those bailouts will be for workers, will be for maintaining production lines. It will not be for buying back shares. So the biggest bid in the equity market is no longer there and is unlikely to come back before the cash flows are fixed by governments, and that could be 6 to 12 months. With volatility where it is, we know that the rules-based funds are also going to have a problem, which is often their equity allocation was dependent on realized volatility being, let's say, in the equity space. So this is the amount that the S&P would move each day, would be around about a 16 vol. Well, we're way above that on a 3-month basis. These are all way above the levels where these funds are now sellers of equity. If you take the pension fund industry itself, what happened on a daily, weekly basis is that people worked, got paid, and some money got put into a pension fund, which would find its way into bonds and equities. Well, we now know that for the next 2 or 3 months, a lot of people are not going to get paid. There's an expectation that the initial jobless claims in the US this week will hit well into the million mark. Well, some people actually argue it could hit 3 million, compared to a peak initial jobless claim of around about 700,000 over the last 30 or 40 years. If people aren't earning money, they're not putting them into the pension funds. Those pension funds are not going to be the bid in the market. So they're out as well. And then you have within the pension funds the makeup of people having probably too much equity, which we'll come on to. So in many senses, we've seen a shift in the whole fabric. But I think the longer term impacts can be seen just through some of the examples that I've experienced myself and we're reading in the press in terms of pensions. So the pension crisis is something that has been festering away underneath the surface for many, many years. Future pension, well, the pension liabilities in the future are in the tens, some people would say up to $100 trillion, i.e. this is the underfunded pensions. Now, with equity markets that are falling and with bond yields providing very little support either, those liabilities will be increasing. But in a very real sense, today, there has been an expectation, at least at the beginning of this move, from a lot of people in the pension industry, a lot of private wealth advisors, who are all saying, look, buy the dip, buy the dip. You always buy the dip and markets bounce back. But what we're now seeing is that, for instance, in the UK, in 2015, people were able to move into self-invested pension plans, SIPs. This is where they took the money and looked after it themselves. Many people were encouraged to take more equity exposure because bond yields were so low. Now, there are examples of some key income funds in the UK down 40% in line with the UK market. The problem is that also the dividend yields are being cut. So in the way that corporate buybacks won't take place in the US, dividends will be cut. The yield may stay roughly the same, but because the capital has fallen by 40%, the income has fallen by 40%, in some cases more. So many pensioners who are relying on these equity pots and their dividends for their income are now going to see their income decline. We know that the economy is not going to recover in 2 or 3 weeks or 2 or 3 months. And we also know it is very unlikely that equity markets will have the V-shaped recovery that we're used to in 2015, 16 and 2018. So there's a very real decline going to happen for a lot of pensioners. And this is not just in the UK, it's all over, particularly the developed world where pension plans were put in place, but particularly the US and the UK, where equities were too large a part of those pots. And my own experience is that I've been consistently been tapped to put more money into equities as the market has sold off, and each time I've been saying no. But this is probably the advice that's been given out to many, many people over the last 2 or 3 weeks, to encourage people to go into the equity market on the assumption that we'd bounce back. But we'd only bounce back if the structure and the framework that's existed for 10 years is not broken. But at the moment, I think we'd have to say it probably is. So therefore, what is the response? And what is the response that we're going to get from central banks and from governments? Now, this is obviously key, because before it was all about liquidity. We've mentioned this before, the repo market, the funding market, the shadow banking market. People who had leveraged themselves up and were now deleveraging couldn't get hold of cash. I think that phase has now been, I wouldn't say it's over, but I think they've targeted the liquidity into that part of the market. But this is the financial assets market, the one that's benefited from this whole process over the last 10 years. But what they now need to do is start dealing with the real economy, the fact that wages are going to zero, at least for a month, maybe 2 months for many, many parts of the economy. And the recovery phase may be a lot longer than normal. So the liquidity now needs to target the real economy, The central banks, well, not the central banks, governments, need to give effectively capital directly to workers, to street cleaners, to painter decorators, to bartenders, many of whom will no longer be in work. Liquidity is not going to be for the financial market in the way that it has been over the last 10 years. It's going to find its way into the real economy. And it's going to struggle to find its way into the real economy. And effectively what we have here is a massive pit that has just been dug into which the liquidity is going to be poured. Now, the question here is, isn't MMT going to be inflationary? Isn't this the reason why bonds are struggling? Because if so much liquidity is coming to the market, if so much printing is going to happen where governments spend money on the real economy and then basically sell bonds to finance this, providing a large amount of issuance, and then the central banks through QE will buy back these bonds and therefore hopefully keep yields relatively static. But isn't there a risk that this increased liquidity is going to push yields? Well, yes, there is. Is there a problem that this could create inflation? Well, if this had been done last year when the framework was still intact, then everybody would have said the chances are that the fiscal impulse will be an inflationary impulse because it's a fiscal impulse on an economy that is growing at 1%, but it's a little bit loose around the seams. Today, it's cracking, it's breaking, in fact, maybe it's broken. So it's going to be put into a bottomless pit. But there is still a risk for inflation. And the risk on the inflation side is simply that if you're going to give money to a workforce, whilst telling that workforce that they can't work, then you're going to create demand, but you're not going to create supply. In the UK, we can see this a little bit. Some of the supermarkets are already starting to put up prices. Now, what they're saying is that they're taking off their 3 for 2 deals because many times we're limited to buying only 2 items in the supermarket. My own feeling here is that in the short term, those hits to pensioners and pensions income, the hit to the real economy, the fact that this is a bottomless pit, corporates are drawing down their credit lines, all of that suggests that I still think governments will be behind the curve in terms of providing sufficient liquidity to offset the impact on the real economy. But nonetheless, in specific areas of our economy, and the same in the US when these deals and these packages start to come through, then again, we've still got to be concerned that certain elements of the economy may see the sort of inflation that we've not been used to, and it will be debilitating inflation because it will probably be on the very things that we want to buy, whilst the overall longer-term economy remains relatively under duress. So how will this play out with these governments providing liquidity? It's not like 1987. 1987 was an equity story where equities got overvalued, but once it was done, it rebounded pretty quickly. It's not even 2000, because 2000 was again an equity story. It had a bigger impact because the whole global economy leveraged into the dot-com concepts, which obviously was a bubble which created at least within the equity market, a deflationary impact. But the liquidity provided by central banks through lower interest rates allowed other parts of the economy to take off. In 2008, again, it was a larger part of the economy. Now it was the whole credit space that got levered. But when that blew, and once they worked out how to fix the banks in particular, then again, we moved on. Now, obviously, we didn't get great growth from there, but at least it fixed what was quite an exaggerated move in that finance space in the world of banks and mortgages. Even 2012 within Europe, once they worked out where to target bond buying and where to target the real issues around the periphery, it at least plastered over the cracks in the short term. Today, we don't have that same scenario. This is global. Something like 137 out of 193 countries currently have coronavirus. I'm sure it'll be all 193 before we're finished. So it's clearly not going to be a quick fix like we've seen before. And in some ways, 2008 and 2009 was a remarkably quick fix, considering the widespread impact that the excess of credit had had. But today, the very fabric, the very framework is the bit that's under pressure. But in the meantime, central banks will continue with MMT with helicopter money. It may be inflationary in the longer term, but in the shorter term, this is still going to be fixing the problems that we have. So taking all that together, where are governments here? So governments have probably fixed in the very short term the deleveraging of the shadow banking system. I think that was the story a couple of weeks ago. They've got nowhere near to dealing with the deleveraging or the debt issues in the real economy. They're starting that as we speak, but this will have to play out over many months, and it will require a lot more financial accommodation. So think about this in very much the longer term. Don't think about this as necessarily being the V-shape. It's very, very unlikely. That was the story when the framework was intact. The framework's no longer intact. Central banks and governments are combining to deal with the problems that we have today, but that means that we're going to be in a completely new framework, probably in a year's time. And therefore, think about what positions you have. Consider this is currently pricing for a recession, not a deep recession, and yet nearly everything that we're seeing suggests that this could have far wider reaching impacts than we've seen in our lifetimes. And therefore, put your positions accordingly, think of your positions accordingly. If you're a trader, maybe now is the time to start looking at some short-term bounces, particularly now that hedge funds have switched from being long and starting to play on the short side. That could give some decent bounces, but you've really got to be a trader to do that. If you're an investor, you've still got to look about protecting capital. Yes, there will be some opportunities once dividends have been cut, and you can start looking at those, but we're still in the dividend cutting phase and the balance sheet reduction phase at the corporates in the real world. This is still time to play safe and not try and catch the falling knife.